I suggest that we start. We are very fortunate to have Michael Marrese with us today. Michael is now in his third career, at least, after completing an academic career, a PhD from Penn and being on the faculty of Northwestern University. Michael then moved to IMF, where he was in policy-making career, and now he's with JPMorgan. You probably have a lot of news from JPMorgan these days, especially in the US. Some people are stepping down in JPMorgan, but not much. Michael is on the other on the other side of JPMorgan. He's doing research on CEEMEA region, which is Central Eastern Europe, Middle East, and Africa, which is part of that. Russia is part of that region, and whatever Michael's writing about is always very well and carefully read by all policymakers in this region, but also by investors outside of this region. And we are very fortunate to have Michael. Michael just told me that he's also doing some non-public stuff on countries which are not part of this region, which are exactly the countries where a lot of action is happening now, the south of Europe. And so he will probably be able to answer the questions on that part of the world as well. With that, the floor is yours. If you're happy just to speak and pick up questions during the talk or afterwards.
Certainly, thank you.
Thank you very much. Thank you very much.
Thank you. Again, thank you for spending an evening here. I appreciate it greatly. My own background, as Sergey said, academia, and then in the 1980s I used to come here when this was still CEEMEA, academic Makharov, had an exchange with Northwestern University, and I was the contact and spent time with CEEMEA. So a great history. My responsibility is to head economics and strategy for 39 countries in the emerging markets in this time zone. So we do all of Africa, we do countries in your neighborhood, all of Central and Eastern Europe, Israel, and Turkey. I was just in Egypt for 3 days, in Lebanon for 2. We have an investor trip now in Africa, and I'll be joining the group at the African Development Bank meetings. I'm just giving you the background so that you know. I'm not trying to brag, I'm just telling you this is my job. I was just in Japan, it's our 16 largest clients, so I travel a great deal. My boss and I, Joyce Chang, is a very famous person, she and I take investors to Washington, D.C. every 6 weeks. So we see people at Treasury, at State Department, World Bank, IMF, on topics including Greece, Spain, Portugal, Ireland, and Italy. So within the bank, as Sergey mentioned, I'm on these committees for Spain, Ireland, Portugal, Italy, and Greece. I prefer this to be interactive, so when you have a question, I can just answer it quickly. The purpose of the presentation is to allow me to speak. Without a presentation, my bank doesn't like me to speak. Okay, so I have to have a presentation. Now, the presentation really is the changing contours of developed markets and emerging markets. And the bottom line is that this differentiation has disappeared for many of our clients. So they don't care what you call a country, developed or emerging. Almost all sovereign stories have become credit stories. What is the difference between a traditional sovereign story and a credit story? In a traditional sovereign story, you take a very high-level view of macroeconomics, microeconomics, and legal issues. When it becomes a credit story, then you focus in detail on the balance of payments. You focus on things like target 2 balances within the European Euro area. These are all very detailed issues that no Western European economist would have thought about 2 years ago, even 2 years. Now they're thinking about it because Italy is a credit story. Now, I'm going to come back to that once we get to slide 8, which is the most important slide in the entire presentation. No, in this presentation is 7, once we get there. So the first page basically says, if you go through the entire global business cycle, emerging markets are doing much better than developed markets, much better, no matter whichever way you look at it. The second point in this first page is that the policies of the major central banks for the Euro area, the US and Japan, really have been quite weak because the fundamentals of the Euro area and Japan, and to some extent the United States, are so poor. And those fundamentals are partly poor because there's very little structural reform. I know these are all stock phrases, but there's actually policy implications to that. The second page says, in this environment in which global growth is going to be extraordinarily slow, where are the downside risks? So the first downside risk, the very top, which you probably can't see, but you'll be able to read later, is in China. So Chinese growth has and is in the process of disappointing 3 quarters in a row. So all we're saying there is Chinese growth disappointed 4th quarter, if you look at the structure, 1st quarter of this year, and is in the process of disappointing now. We believe that the Chinese officials will engage in monetary policy and fiscal policy to stimulate growth in the second half of this year. So when I met with Russian corporates today, they were interested in 3 questions, right? Oil price, euro dollar, and ruble dollar. Those are the 3 questions. That's what my job was to answer. But this first point is the most important because unless Chinese growth is stimulated, the oil price is going to be much lower than it is now. You know, say 15% lower. But we're very confident that Chinese officials will stimulate growth. The real risks to growth are in the euro area, and the first risk is that European policymakers do not fully appreciate that they are no longer believed. Now, you're all very young people, you have parents. Do you remember the first time they realized that you didn't fully believe everything they said, that you didn't fully appreciate their advice? It's a big, I think it's a big point in a parent's life when all of a sudden they can see that serious doubt coming across their children's minds. And in the euro area, still today, the decision makers don't understand how little they are respected. The second point is teenage, like in the sense of it's a generation, it's almost a time change, because these are the individuals, great leaders, who had the respect of everyone in Europe. They created a European Union, and they created a monetary union. And for so many years it worked. And now that monetary union, for all the reasons I'm sure you're taught here, is fundamentally incompatible with the people they have in that monetary union. It's incompatible. There's so many papers on this. They go back all in the 1990s, one paper after another. But the second point is that these long-term refinancing operations, these 3-year refinancing operations, the ECB initiated, one in December, one at the end of February. They injected into European banks euro 510 billion. Euro 510 billion into European banks. And to give you an idea of how sweet that is, how sweet, you're borrowing the money at roughly 1%. It's hard to know because it's borrowed on a 3-month ECB financing rate, which now is 1%, but could be 50 basis points, in 3 months. So it is almost, it is free money, effectively free money. in order to save the European banking sector. So the European banking sector is funded for this year. Part of next year, I think there are going to be 2 more LTROs, 2 more. But the second point is that the marginal benefit of additional LTROs has declined. So that's the second thing to worry about. And the third is already happening, the downgrade of key European countries. So if Spain is downgraded to below investment grade, in other words, double B, then our financial experts tell us that roughly speaking, 20%, this is just an educated guess, of the holdings of Spanish bonds would need to be sold. So all of these things feed on one another. And the fourth downside is that Greece could leave the euro area. And the trick here, so you have Greece, and we'll get to slide 7 soon, but you have Greece, and if Greece were to leave today without a financing package just to pay for their exit, forget anything else, just to pay for their exit, you could see a military dictatorship take over. You don't want to see that. I'm just saying, I'm not saying they will, I'm just saying that's one of the things that decision makers are worried about. That's how extreme conditions in Greece have become. So you can read that clinics and hospitals are short on medicine, you can read about poverty, all these things are reality. Okay. This just gives some demographics I put in for some of the readers. And this just looks at growth and inflation. And then what we see here, and it's just a graphic representation. For 2012, if we look at global growth, I know you can't read it, but global growth, the U.S. will contribute a bit over 25% of global growth in real terms. China, a bit less than 25%. Next year, we're saying China a bit over 25%, right? And that the U.S. a bit under. But the point is, China and the United States are responsible for 50% of real growth. Real growth.
PPP or
market exchange rate. Market exchange rate, not PPP. Now, global inflation moving lower. And this is the chart which you can't read, but I spent 1 hour with the Bank of Japan on this chart. We didn't move. They only wanted to look at this chart. Now, the first thing to note, I'm going to focus on the U.S. for a minute, and I know you can't see this, but maybe later you'll look at it. If you could see the top line in that chart, you would see that gross public sector debt to GDP in the United States is 105%. The end of this year, 105%. Now that compares to 82% for Germany and 90% for France. And yet at the moment, no one is worried about the United States. At the moment, 10-year U.S. Treasuries have yields of 1.8%. And again, it's almost like free money, and it affects Russian corporates and banks, because Russian corporates and banks can borrow cheaply when the markets are open internationally, because U.S. Treasuries are low. If international investors lose faith in the United States, then that 1.8% easily could be 4.5%. And that would increase the borrowing cost for all Russian banks and corporates. Okay, so that's clear. Before we go to Europe then, I just want to mention 3 challenges the United States has. The first challenge is near term, and on the face of it, it should be easy. If you go to the top line again, and if you could see the 4th column, you would see that the United States has a revenue to GDP ratio, all levels of government, of 32.6%. 32.6%. If you could see, which you can't, the rest of the line, you'd say that's obscenely low, right? And you go back to the late 1990s, and you go back even a little further, and you see that the normal rate's about 36. So you could easily, in quotes, increase revenue to GDP by 10%, a bit over 3% of GDP, if there was some political cooperation. Are any questions so far? Any questions? Okay. So that's the first thing. The U.S. has to, roughly speaking, tighten its fiscal policy to show that it's on some sustainable path. And this will happen after the U.S. elections in early November. After. The second thing, I'm going to go the easy. Second thing is Social Security. Every country has a Social Security problem. The country that's dealt with it the best in the entire world is Italy. Italy is by far handled the Social Security problem the best. In Russia, you handle it by having all the men die early. As long as men continue to drink a lot of vodka and die early, then Russia pretty much solves its pension problem. I hope you guys, are helping, the motherland here. Okay. It is the motherland in Russia. In Germany, it's the fatherland, but in Russia, it's the motherland. Okay. Now, in the United States, the solution is a tiny bit painful, but basically, you have everyone receive their state pension a bit later, and you have people who make, a good amount of money, contribute higher up their salary scale, and you can solve it. So basically, have people retire a bit later, and have the relatively well-earning population contribute more. Okay. The third challenge for the United States is the most difficult, and that's health care costs. So the United States spends all in 16% of GDP, 1/6. Russia, if you calculate it properly, I would say a little less than 6%, tiny bit less than 6. So the U.S. spends 4 percentage points of GDP more than France, more than Japan, more than Canada. Those are the countries that are sort of second place. In order to solve, and the promises are forever. So the U.S., our President Barack Obama, and other presidents always promise more. They don't promise less, they promise more. The promises are just too great, and so essentially there has to be some form of rationing as you get older. You're eligible for fewer procedures as you get older. I'm already, almost 62, so I'm already going to be rationed. Okay, so I'm not talking about, it affects me. So those are the challenges the U.S. has. So I don't want to minimize those. Now we're going to come to Peripheral Europe, and that's okay, great. So here's Peripheral Europe. These are the 5 countries I spend time on. And we see, first of all, let's talk about Greece. So Greece is here. Greece has, at the end of this year, after there was tremendous default on Greek sovereign debt, 170.4% gross government debt to GDP. After that, okay? Notice, which is very good, that Greece is not a heavily levered country. See that 233? That's household debt, gross debt, that's corporate gross debt, and that's government gross debt. So there's almost no household debt at all, almost none. And corporate debt is also relatively small. Now, that may not seem important, but when I tell you the story, it will be. Okay, you ready for the story? Any questions first? Okay.
And that's a question on the U.S. You mentioned that there is a potential for increasing taxation taxes by 4% GDP. What is the cost of expiration of tax cuts? So
Okay.
you just let them expire.
Right. So, if I'm going to answer the question, I'm going to give the answer first. 4 percentage points of GDP. So if you let the tax cuts expire and you implement the sequestration already agreed, if you did both, and then there's a third thing. If you would let the deduction for unemployment insurance expire, if we do all three of those, 4% of GDP, 4 percentage points. So that would probably mean instead of U.S. growth at 2.2%, it would be almost zero, or 0.5. JPMorgan is assuming 1.5% contraction next year, fiscal contraction on the federal level. So federal government deficit would go from 7.7 this year to 6.2. Interestingly, and I doubt if any of you know this, in the United States, the federal government and U.S. states, there are 50 states. There are 83 regions in Russia, by the way, in case you didn't know that, 83. Okay. There are 50 states in the United States. You take the 50 states and all municipalities, in other words, local governments, they spend roughly the same as the federal government. Now, the summation of all states and local governments is in surplus in the United States, roughly 1% of GDP. So that part of the equation looks good. So it's the federal government. And instead of 4%, we're saying the reduction will be 1.5. So on Greece, that's unsustainable. Unsustainable. Now, the Greeks have a new election on June 17th. And while every day JPMorgan has a huge internal debate on this, I firmly believe the Greeks will vote for parties that will not cause Greece to leave the euro area. Firmly believe it. I can go through the details, but I'll do that in question and answer. What does that mean? That Greece is receiving money, 50 billion euros to recapitalize a bankrupt banking sector, but 50 billion euros. 50 billion. That's about 20% of GDP. Those are in dollars, so GDP is about 240 in euros. So over 20% of GDP to recapitalize the banks. And if you look at deposit information, which is not here, household deposits are leaving the banking sector very quickly. So household deposits are being shifted outside, so the households are hedging themselves against an exit from the euro area. Corporate debt, which was never large, because you take the 233 and subtract, roughly speaking, the 170, and you get, say, 50% of GDP is corporate debt, roughly. They're selling their non-core assets and paying off their banking debt. They're also hedging themselves for a departure. So it could be that in 2013 you'll see departure. But by that time, these other countries will have worked to shore up their positions, and the European authorities, I think, will have a program of assistance for Greece when it leaves. Okay, so two things will happen. Now, with regard to this first idea of creating a firewall, let's take Spain as the example. So Spain has 80.4% general government debt to GDP at the end of 2012. That number for that same period of time was 75 1 year ago. So the problem is Spain continues to readjust its figure up and up. And you go around the world, whether it's Germany, I talked to one of the largest banks in Russia today. I asked their treasury how many Spanish bonds they had. What do you think?
Zero. No.
Zero.
No.
Zero. So the point, here's the major point. You go around the world, whether it's Japan, and I ask the same question. And 2009, how many Spanish bonds you had? And what you have today? The Japanese just don't sell everything. They just wait until they mature and they don't buy. But the point is that both Spain and Italy have lost roughly 40% of their natural buyer base for their international debt. And that's why now Spain is going to need a program from the Troika. So I think I would put my best guess September. So September, you see a program for Spain, and Spain's GDP is about €1 trillion. So the program would be roughly 200 billion euros, 20% of GDP. So it's not enough in some sense. Spain would still be dependent on financial markets, but roughly 80 billion would help the banking sector, and 120 would focus on covering maturing sovereign debt, 40 billion a year. That would cover 40% of Spain's, at least 40%, maybe 42% of Spain's maturing sovereign debt. So not a perfect solution, but it's one way to create a firewall around Spain. Portugal and Ireland will be receiving second programs this year. And those will be for roughly 40 billion each. That will take them out of the capital markets till end 2015, roughly end 2015. So then you're left with Italy, the homeland of my grandparents, and the most recent fiscal numbers are somewhat encouraging. It could be that Italy's gross debt to GDP will stabilize this year. And there's a chance that by the end of this year, a chance, not a certainty, that Italy will be characterized as a country with twin surpluses, with a primary fiscal surplus and with a current account surplus. So for Italy, they have to rely on their own resources and what's called financial repression. And financial repression is the monetary authorities encouraging the banks to buy their own sovereign bonds and the population. Okay. Any questions now? Okay. So if we go to the U.S. for a minute, so the U.S. we're looking, the U.S. we're looking this year at 2.4% growth, and next year 2.2% growth, slower than this year because of the fiscal contraction in the federal government. Okay, and there are two pieces of good news for the U.S., and I mentioned one here. Home sales have been on an upward trend. At least today they announced it. And you'll see in the graphs that home prices are going up a bit. Yes, please.
Thanks, Anton.
Anton, nice speaking.
I'd like to ask you a question. Does the growth of the economy has to do anything with bond issue?
Does it have anything to do with, I'm sorry, bond issuance?
Yes.
Yes. Okay. Yes. So, the U.S. So in two aspects. The more business aspect is U.S. corporates are richer than they've ever been. Right? What was it? One of the U.S. companies had more than $80 billion in spare cash. They have lots of cash. Yet they still issue bonds because it's so cheap to issue bonds. So there are also two reasons for this. So it's just the first point, and there are two reasons. One, they want to issue bonds because strategically, many U.S. corporates believe there's going to be an explosion in Europe, and that they will be able to buy European companies for 20% of the value you have them today. So, and this is not just U.S. companies. The Chinese are out there. They are prepared. The Japanese are out there. I know. Japanese are out there. The same thing. So people are waiting for the euro area to implode. And the second reason they're issuing the debt is just because they are worried about this. They're worried about that 105% and that U.S. policies may not be good policies, and that tomorrow it's going to be very expensive to issue debt. So you're building up an insurance fund internally. Those are the two reasons. The other way it affects growth is that the federal government is able to issue debt very cheaply. So that helps the federal government also, and state governments. Everyone issues debt cheaply, U.S. states. So that's a good question. So the two sort of, sort of silent positive factors in the United States are home prices going up, and the construction sector is starting to actually contribute to growth. And the second we don't have here is automobile sales. Automobile sales have been surprising on the upside because the average age of the U.S. automobile personal passenger automobile stock is 10.9 years. 10.9 years. It's very old. It's very, very old. Because people put off those purchases because of the state of the economy. Okay, so what we see here, this is U.S. household wealth. So it's household wealth. And household wealth in the United States is the value, the net value of your home, and the value of your equity, so stock, the value of your bonds, and savings accounts. So that value now is about 5 times disposable income. So that your disposable income, think of that as your income after taxes, right? So your wealth is 5 times disposable income. That's what it was between sort of 1952 and 1967, so a 15-year period, and that's what it was between 87 and 93, 94. But these two peaks, the first peak was the dot-com bubble. Okay, so equity prices went up to obscene levels, and the second was the housing bubble. That's why they went up so high. Now the second thing, this is related to your question, Anton. So interest rates are very low, and look at the debt service for U.S. households. It peaked at 14%, and now it's down to 11.1%, below historic average. So this is what's helping U.S. households. The cost of servicing debt is so low. In addition, household debt has come down from its peak. It peaked at 130%, and now it's 112.7%, and it's likely to be close to 105 at the end of this year. This number is end 2012, so it's likely to come down to 105. So households are deleveraging in a sensible manner. So the U.S. savings rate, which is tremendously high, it's a little above 4% now. It's certainly not the rates it was at one point. And the best piece of information is right over here. This is total compensation in nominal terms. Total compensation in nominal terms. And what are we talking about for the U.S.? A little below 2%. Can you read that? See, there's 2%, and just slightly below 2. That's the blue line. So the brown line is wages and salaries. So that's about 1.7%. That's what you see in the United States. So from a real perspective, wages and salaries are basically stagnant, no real growth. Okay, house prices just maybe you can see they're going up a bit. That's right over here. And you can see that this is also interesting. So this is related to U.S. growth in the next several years. house prices have come down tremendously. So they came down. You see this period of negative growth on a year ago period. So during this entire period here, house prices are falling. And yet home ownership, which was 67% in 2000 and peaked at about 69%, now has fallen to about 65%. So a lot of people now rent instead of buy. That's the message. In addition, since the end of 2007, you have 5 million new households in America. So the point is that there are lots of people who would like to buy. So there's potential demand, and because, let's see, oops, it's really cheap. Interest rates are low. So it could be there'll be some surprise on the residential sector. Okay. So Euro area, what the European officials are saying is that there'll be no more private sector involvement, and that is just restructuring private sector debt. So if you held Greek bonds, you lost 53% of the face value of those bonds. And if you look at the original face value versus today's market price, right now your market price is about 9% of that initial face value, 9%. So that's a tremendous hit for any private sector holder of Greek debt. And now the European officials are saying no more private sector involvement, right?
So what is the amount of Greek debt, the market value of privately held, by the Greek debt held by the private sector?
Okay, so I'll give you the figure at the end of this year. Sorry. It's, by the end of this year, we're going to have Greek private sector debt 60 billion euros. 60 billion euros.
That's face value.
That's face value, 60 billion, and the market is 9% of that 60. So,
Zero.
so it's below 6 billion.
Yeah.
It's below 6 billion, 5.4 billion. That's the level of disbelief that the market has in Greece's prospects. And the reason, so we have this huge debate about whether it pays to buy Greek bonds. And my position has been it's likely Greece will leave the Eurozone in 2013, or at least there's a high probability. Therefore, if Greece leaves the Eurozone, that face value, the market price of the debt is going to go even lower than it is today. Okay, so what do we see in the Euro area? This is the composite Euro area PMI, and you can see that it's declining. So that's the level at which, at the level you had at the start of the 2008-2009 recession, after the Lehman disaster and default, right? That's the level, and look at where you've been now. So we go, let's see, unemployment also looks like it's at the early stages of a recession. So the higher the worse, unemployment, and you can see it's consistent with the idea of a recession. We're saying there'll be 3 quarters, 9 months of recession on a sequential basis, but it could be longer. And then this is interesting. The 3-speed Euro area recovery. Germany, which surprised on the upside, growth was 5 times faster than expected in Germany in the first quarter. Core Europe ex-Germany, okay, and peripheral Europe still going down. And core ex-Germany, so that's Austria, the Netherlands, France, etc., still is below 100. Okay. So this just says, you can look at it when you get the presentation, you can see these numbers, but this just says if you take a country like Spain, Spain has, let's see, where's the best one? Okay, so for Spain, we're looking at a budget forecast for 2010 that was about 9.8, and then we had said the forecast for 2011 was 6. It turned out to be minus 8.9. So that's the idea here, is that on the whole, Spain did well in 2010, but huge disappointment in 2011. And then we look at holding the line on budgetary slippage. We look at the impact on 2000 budget of weaker growth. That's what we see across the board. It'll make the budget that much more difficult to reach, so that gives you the impact on growth. So for Spain, the weaker growth is likely to mean additional fiscal slippage of 1.5%. Okay, and this gives you the outlook of the euro area, and it gives you some ideas of how the debt has moved between 2011 and 2012. And then everything was looking pretty good in Europe until roughly half of 2010. And if you remember, July 2010, that's when the first mention, that was, no, this is 2010. Okay, this is the Greek restructuring here. At the beginning, it didn't matter. Things got a little better into 2011, and then in 2011, middle of the year, they talked about PSI increase. I'm not saying they shouldn't have done it. I'm just saying once they did that, lending to households has begun to decline, and European banks have been deleveraging. So European banks have been deleveraging, in other words, lending less and less, since roughly mid-spring 2011. And this is the idea: is there a credit crunch? Fill bank loans to households and non-financial corporations, and you can see which way it's headed. 3-month average. So the latest data show not exactly 0, but close. Any questions then on the euro area? Certainly.
Yeah, I think this is one scary question. But you mentioned that it is likely that, or at least you would probably believe that the pro-euro forces will, or pro-eurozone forces will win the election. That makes that is rational.
Right.
What
happens if it doesn't?
What are the incentives against that? Because if you think about these issues, whatever happens in Greece, it's in the Greek politicians and voters' interest actually not to go for catastrophic scenario, because even if they exit euro, even if they default, they will still have to cut the expenditure. They will have to do austerity package. It's just not going to be a slow or evolving austerity package, but more like a catastrophic scenario. They will have no cash anyway.
Yes.
So what are the incentives on the other side of the debate?
So there's a group in Greece that believe that Germany will pay no matter what. So that if Greece is very strong now and says, we want to tear up the agreement, we want all the money, but we want none of the fiscal austerity. We don't want to cut government jobs by 150,000. They're supposed to eliminate 150,000 government positions. If that's the case, then we would have Germany would come and just spend more money. That is the fundamental belief. So if you look at Germany, going back to that slide, this is what's ironic. So Germany, we have the number. These are official European Commission numbers. 82.2%. That's the only number in this area here that's lower than 1 year ago. So Germany found out that they made a statistical mistake, but that they have less debt. Less debt. So again, Spain 5 percentage points higher for the exact same time period in 2012. The initial number here for Greece after the PSI was going to be below 160, more. Ireland's about the same. Italy's the same. Portugal's higher by 10 percentage points. So Germany, many people feel, we're looking at a general government deficit this year of minus 0.9%. So their debt dynamics are on an improving path. Why can't they spend an extra 5% of GDP to help Greece? Why not? That's the argument. Okay. So are there any other questions before we go to Japan? Yes, Professor Markov.
Why Greece doesn't want to sell state property like land, like they have a lot of islands, empty islands.
Right. They do. So, academician Markov, great seeing you. Thank you for joining. Greece has done nothing, seriously nothing, since April 2010. Right? Nothing. Portugal, I'm going to answer the question, but just a second. So Portugal already, in half the time, has sold 3.3 billion euros of assets. Greece, nothing. Portugal, surprising on the upside. The Greeks say property rights, ownership is unclear. I mean, that's what they say. Ownership, it's very complicated. I've been there with clients. We've consulted legal experts. But there is no will to sell things. There's zero will. Ports, the Qataris have indicated interest in ports. It's possible, but again, in my opinion, they just do not want to sell anything. But they could, right?
But this is resistance of people, right?
Yes, it is. So it's a political, very much a political issue. In London last week, we had the finance ministers from Latvia and Lithuania. Now, their message was the following. They didn't say this, so these officials did not say what I am about to say. But you could solve the problems of some of these high-debt countries by sending the population to Siberia for 10 years and then have them come back. But that was the message, because the ministers of finance said, we know how difficult it can be. We know how difficult. What did the Latvians do? They cut public sector wages 30%. 30%. Now, they had been growing quickly, but then they slashed, because 75% of their adjustment was on the expenditure side. 75%. They slashed government institutes. They slashed hospitals. They slashed schools. And you had, for Latvia, just a second, you had Latvia in 2007, 8, and 9, roughly speaking, GDP fell 25%. It could be 27%. And last year, in 2011, they grew, just a second. Here we go. They grew 5.5% last year. So it fell 25% in 3 years. They grew 5.5% last year. We're looking at 3.1% growth this year. Still, unemployment's 14%. So it's not as though they've solved everything. unemployment rate's 14%. But it's very much a matter of will. Any other questions? Please.
Hi, my name is Rustam. I would like to ask one question. Do you personally believe that the Eurozone will stand these current problems? And if they will, I'm sorry, how long do you think will it take us to see financially sound Europe as it is now, like the whole Europe? How many years?
Okay, so we go back to the magic slide 7. The target two imbalances, for those of you who study the ECB, the target two imbalances are the accumulation of unpaid current account deficits that national central banks finance. So the Bundesbank in Germany currently has a target two balance of minus 660 billion euros. 660 billion. Now, that is, if I remember correctly, roughly 20% of GDP. So it's not a small amount. Not many countries are going to be willing to do that. So Italy could have a current account surplus soon. It's possible. Ireland has a current account surplus now, but it's a dodgy current account surplus because that includes repatriated profits that countries around Europe put into Ireland. So it's not a really sound, but at least they have. So you have Greece could exit, Cyprus likely to exit, right? And then Portugal is a question mark. So the current account deficit for Portugal in 2011 was 6.4% of GDP. If you look at I'm trying to answer your question, I am. So if you look at the April 5th Fund program for Portugal, you'll see that they expect Portugal to have a current account deficit through 2014, still 2.4%. So unless there are new institutions formed for the euro area, it's likely several countries will have to leave it because the rates of productivity growth are too large. So it's not sustainable in that sense. So all of those academic papers from the 1990s, which I should have paid more attention to, many of them were right. They really were right. Now, when I go to Germany, I give them advice, and I've given this at the Ministry of Finance, that the Germans should take an extra 3 weeks of holiday every year, right? Because that would help solve it. Then they wouldn't be so productive on an annual basis. So my wife taught in Germany last year, and I also mentioned that to the faculty at the university, but no one laughs in Germany. They say, no, we have too much holiday already. So, part of the answer is that the Germans expect the weak countries to become more Germanic. That's sometimes difficult to do. Yes, that's it. I mean, that's what I was trying to say. I didn't say it well. The real economy, Italy has a chance of making it. Ireland, in some ways, is making it. Portugal is a big, big question mark because if you look at the structure of the Portuguese economy, they've only been growing about at a 1% rate. So they are cutting wages in the private sector. Maybe they'll attract some investment. They've been good at privatization. But when you look country by country, it looks as though the euro area will have to become more compact. It looks that way.
But even in that sense, Germany now is violating Maastricht criteria, and it will take many, many years, even for Germany to go back to 60% of GDP.
Yes.
Debt to GDP ratio. Is that likely, or
no? So again, getting back to this page, it's likely that 60% ratio is going to become 90%. It is. It's likely it'll become 90%, not 60%, including for the U.S., right? I mean, it could be that the U.S. will get back to some sensible ratio, but not likely for decades. How long do the talks usually last?
So we end in half an hour from now.
Okay.
But if you want, you can end now and take questions from the audience.
I'm happy to take. We can do Japan and China if you'd like. I'm happy to do Japan and China. Okay. So Japan, we're looking at 1.7% growth. Potential growth is 0.5. Now, there are two factors here. One, the Japanese population is basically working longer hours without additional pay. So people are just working longer hours. So that's one factor. In addition, the public works projects have been ongoing. So longer hours, no pay, public works projects. They had the supplementary budget. And so Japan's gross general government debt to GDP is 200% or 205%. And the reason they can do that is that 97% of all Japanese government debt is owned by either Japanese households, the Bank of Japan, or other central banks around the world. And the other 3% is owned by hedge funds that play the curve. It's a deep market. So what we look at, Japanese policymakers are concerned about the yen strength. They can't do anything about it. And then we have all Japanese nuclear plants have been shut. And the replacement of nuclear power by fossil fuel requires an extra 0.7% of GDP of additional imports, spending for imports. And that would cut the trade surplus by about 40%. We still have deflation. You may know that the Bank of Japan now has a target for 1% inflation. When I meet with policymakers at the Bank of Japan, they are afraid they're not going to make their target of 1% inflation. Now, the answer to that is easy. Again, an economist says this. They have a consumption tax of 5% now, so that's similar to a value-added tax. The ruling party's research commission, research, has announced plans to increase it to 8% in October 2013, 10% in April 2015. So that's what the Japanese are doing medium term to try to shift their debt dynamics, increase taxes, but that'll slow growth. Okay, China. China's the most interesting situation. Okay. So, China, we're looking for 8% growth this year, and we see it increasing the next 3 quarters. Okay, this quarter 7.8% sequentially, 7.9 and 8.1. The reason we've downgraded our 2012 forecast is because policymakers have been slow. So in Japan during 2009 and 2010 and partway 2008, in China, the central government loaned money to municipal financial organizations. The municipal financial organizations spent it on every type of infrastructure project you can imagine. If you look at the website of the People's Bank of China, you can see officials discussing the NPLs related to that surge of public sector spending. And there are respectable, independent individuals out there, including at the People's Bank of China, that suggest that the Chinese are going to have to inject 30% GDP into their banking sector. So Russia has general government debt to GDP of about 11%. Some people say 9, but let's say 11. China has roughly 20%. But once they inject this other 30, they're going to be up to 50. So the Chinese officials are very smart. So they've been slow to stimulate the economy because they don't want to do it in the same manner they did in 2009, 2010. So what we believe they're going to do is take the required reserve ratio, which had reached 20.5%, and bring that down to 16. So there'll be more domestic liquidity. Right now it's at 20. They've gone from 20.5 to 20, and we think they'll go down to 16. Secondly, there are huge inequalities in healthcare and education. So we believe the central government officials will spend more in healthcare and education in the interior of the country, the poor areas. Okay, here it is. Chinese loans to the household, sorry. Here, this was here. Loans to the household sector is only 19% of GDP, so the household sector is not heavily levered. But loans to corporates and government have reached 134% of GDP. That's where the NPLs are, right in here. And that's where you're going to get easily the 30% of GDP. So, again, what we're saying is we're going to see two things. One, the stimulus and 8% of growth this year, 8.9% this year. And this is something important because Chinese manufacturing costs have risen. So this is just a 2010 number. $450 per month was the Chinese labor cost manufacturing versus less than $200 in 2005. That number for 2012 is almost $600. So China's been losing manufacturing jobs to Vietnam, to Indonesia, other countries. So that large current account surplus you saw in Japan is coming down rapidly. Last year it was 2.8%. Just a few years ago it was 10%. So there's rapid adjustment. Global imbalances, here we go. So Italy, so we still say minus 2.2, so they still have a ways to go to get to that surplus I'm talking about. But our bank has never been good about estimating these current account balances. So China, 2.8% surplus last year. I don't think they're going to hit the 2.8% surplus this year. But our bank last year started at 6%. So, people just don't fully grasp what's going on in China, I don't think. So narrow of current account balances, major policy changes, at least that's going away. Now, this is very important. If we look at recent depreciation in EM currencies, the ruble's been okay, right? You've had, if you look at it, it was May 18th, okay? So that was last Friday. Relative to the US dollar, it depreciated 6.2%. So in the middle, right? Brazil, 9.1, Turkish lira, 2.61. Just, 6 months ago, literally, 8 months ago, Brazil had been imposing capital surcharges if you wanted to invest in a currency, 6% of your investment. So now they're taking those off. So the world changed very quickly. What we see, the other thing that you may find interesting, is that during the latest LTRO in Europe, remember when you're getting the money for free, almost, you're paying 1% for 3-year money? some of the European banks, understandably, this is not underhanded, this is pure good business, borrowed the money in Europe, and what did they do? They shifted it, say, to Turkey, where you have 9.8% right now on 18-month money. So you do have an exchange rate risk, but 9.8% is a nice return on 18-month money. So when you see these additional LTROs, you'll see money floating into a number of countries. Turkey. Russia's a funny situation because global investors are wary about investing in Russia. In 2008, global investors in Russian corporates lost a lot of money. So when I go around and meet all these clients, we have a very positive story to tell about Russia. But relative to other countries, they're just a bit more wary. They're worried about property rights. They're worried about the role of the authority. They're worried about legal rules. For instance, let me give you two examples for Russia. So Russia, which has an aging population, one would expect Russia to issue inflation-linked bonds, right? For the insurance companies, for the public pension, inflation-linked bonds to assure that the pension possibilities of the retirees are protected. That would be normal. We don't see it in Russia. So people ask why. Okay. The second is Russian bonds. This is a technical issue. At present, except for one issuance, are not euro clearable. Russian domestic bonds are not euro clearable. And it was supposed to happen the 1st of July. It may happen the end of September, maybe. But there's domestic resistance. So Russia's commitment to be a serious financial market is called into question by investors. And this just gives you some movement on exchange rates. So I think my favorite is Brazil. So this is from January 2004 through April 2012 in real effective terms. Real effective terms. And we have Brazil's real appreciated 83.9%. So Brazil is also a commodity exporter. Again, it's hard to see. 83.9%. Most of that occurred before Lehman. The second column is Lehman. The third column is the Big Mac index. That's not a serious index, but some clients like it. So a Big Mac, if you take the exchange rate at this time, is 35% overvalued, more expensive than in the United States. Now Russia, here's the ruble, also a commodity exporter, 55.7% real effective appreciation. Everyone understands real effective appreciation. It's trade weighted based upon differential consumer prices. So, and even more so since Lehman. But the Big Mac indicator says that Big Macs in Russia are very inexpensive. Interesting, right? Brazil expensive, Russia inexpensive. And then you have a country like Turkey, which by design has kept its currency cheap. It's depreciated despite very high growth and very good macro indicators, minus 6% since January 2004, minus 16% since Lehman. That's by design. They wanted a weak currency. So, the US dollar has depreciated 12.8% since January 2004, but actually has appreciated since Lehman. And the euro has depreciated 4% since January 2004 and almost 10% since Lehman. And Japan's getting crushed because that appreciation since Lehman, 15.5%. So that's the the general presentation, and I'll take questions.
Thank you very much, Michael. We know everything about every single country in the world. We can ask more questions about specific countries or specific issues.
My name is Oleg. May I ask a question? You said that Brazil is like your favorable country to invest, and as far as I know, recently Brazil nationalized one of oil extracting companies. And what is the attitude by investors to such behavior? Does it change if the country behaves in this way? Does the attitude of investors change to this country, and how much it takes to restore the attitude?
Okay, great. Okay, thank you very much for the question. So, just a slight clarification. It was Argentina that nationalized the oil company. And Argentina does not have a good reputation among investors. But let's go back to Brazil. So Brazil was able, so if you're in business, okay, if you're in business and you're going to start your own high-tech company, okay, you're in business, and in order to attract venture capital, which is new money to fund your brilliant idea, you need to find either many people who invest or one very rich individual. Okay? Brazil found one very rich individual. Brazil found Japan. It's serious. This is no joke. So JPMorgan, I'm going to get to the serious part, but JPMorgan, our bank, makes per year, okay, last year we made almost $2.5 billion in emerging markets. Not bad. Now, of that amount, 1/3 of that amount comes from dedicated sales to investors globally who are interested in emerging markets. We have a dedicated sales force. 1/3 comes from special financial engineering. And we do that for companies all around the world. And 1/3, no, 30%, not 1/3, 30% comes from our Japanese investors. Tokyo. So JPMorgan is a big bank, right? We're everywhere. But the truth is, our gold mine is Tokyo. Where do they invest? Brazil. So you look at Brazil investor flows in the real economy, in equities, in fixed income, Japan. And that comes from retail. Because retail is earning on its investments in Japan maybe 0.5% per year nominal. In Brazil, they're earning 10 to 15%. So what you've seen is this tremendous inflow of money from Japan. For the last 2 years, the Brazilians have implemented these capital controls, and the Brazilian authorities have gone to the Japanese authorities saying, we don't want your money anymore, because it distorts the currency. The currency becomes overvalued. That's that chart on the Big Mac Index. They said if you go to Brazil, you'll see everything is more expensive.
So better not to expropriate.
Można po-ruski.
Make me excuse, Michael. I would like to ask you a very strange, probably provocative question. It relates to this topic. You know that territory is a limited resource, and it is distributed among countries historically. And the only way to redistribute territory space is a war.
Is right.
But there are some examples like runs to states. Same thing happened to Alaska, but these are exceptional examples. But let's think about, is it possible, in principle, in probably foreseeable future, to organize international market of space? And if it happened that Japan will buy Kuril Islands or and so on. But of course, it is difficult to put it into discussion. For example, our communists say that you sell your motherland and so on.
Yes.
But in principle, what's your opinion? Is it possible to start this market of, because in the case of Greece, it is bankrupt, but they have a lot of empty islands, and a lot of people want to buy this island. So, what about the market of all these things?
So in
Michael, before you
Yes.
respond, my advice to you is to use examples outside of Russia.
yes, okay.
Within Russia, if you ask for buying or selling or changing Russian national borders, it's actually almost a criminal offense.
This is good advice. This is good advice.
So if you use other examples, that's
Very
my
good
advice.
advice.
But theoretically,
Theoretically,
No.
even theoretically,
Yes. So theoretically, outside of Russia, theoretically, it's possible. And so here, this is the. Well, let me give you the history of Greece for this, okay? So if you looked at Greece figures at the beginning of 2009, then the debt figures said one number, something like gross government debt to GDP was something like 85%, some number. And that the deficit was going to be 3.4%. Then you had another number in September, at the beginning of September, and another number in the middle of November. Our investors, I was lucky to meet with investors who saw this coming, and therefore I had knowledge from investors, not from myself, about this. At that time, near the end of 2009, many banks investigated whether Greece would be willing to sell large chunks of land. So, although not exactly as elegant as you're suggesting, banks looked into it. And two things occurred. These are not logical. One, supposedly, European authorities were against this because of issues in Spain about different groups wanting to create an independent entity. So there were concerns about changing borders throughout Europe. So in looking at this, whether you're talking about Kurdistan in Turkey, Iran, and Iraq, or you're talking about an area of Spain that could become an independent country, the response banks received, including a bank like ours, is this would not be encouraged. And then the Greek officials themselves felt this was not politically possible. So not a good response, but you're correct, it's much better than more. Much, much better than more. So it could be that at some point in time, there'll be some decision. I'm not sure what's going to happen to Cyprus. So didn't Russia just was one of the state banks, $5 billion, or no, it was originally going to be $5 billion, but I think it came to $2.5 billion. So it's outside of Russia today, but maybe tomorrow it won't be outside of Russia.
For all practical purposes, it's part of it.
It's part of Russia. So again, a good idea, but so far there's been resistance in Europe.
Michael, can I follow up on this? this kind of interaction between financial problems and social problems. In China, in the end of 2008, I talked to Chinese policymakers and academics, and they said 8% growth is the lowest we can go down to.
Yes.
Because of social issues, because we need 8%
Yes.
growth every year to provide new jobs to young people. And so your bank is now given a number below 8%.
Yes.
And we know that China, as you just mentioned, has a lot of firepower to maintain growth if they need to,
Yes.
at whatever level they want, by throwing in 10% of GDP, 20 or 30% of GDP over several years. What do you think is now a socially acceptable growth rate to China? Because I think this is probably even more important than rational economic fundamental for growth rate.
So the current 5-year plan, the one they just
Yeah.
adopted, has a 8% growth target.
Exactly.
8%. The previous 5-year plan, I thought, had 8.5, if I remember correctly. 8.5. So let me give you just one more, in quotes, fact. The measure of income inequality in China has risen tremendously. So if you take the year 2000 and looked at complete figures for 2010, so over a 10-year period, the measure of income inequality has risen. So from a policymaker, sorry about that. So this is the key for China. We look at the median age is 35.5%, but the percentage under 14 is 17.6. That's less than France. That's about the same as the UK. So what you see is a population that's actually going to be aging very quickly, and the population relative to India, one of its competitors, is much, much older. So for China, the authorities are much more interested in income distribution and, in some sense, the quality and distribution of growth, who benefits. So I think the 8% is very acceptable. We have had academics speak at our conference, and they also think 7 would be socially acceptable, given the increase in the labor force.
Okay, we have probably, we can collect probably 2 questions and then get
My question is about American economy. Do you expect any improvements in the case if Obama loses the elections this year, comparing to his victory?
Okay.
Thank you.
And I'll take, yes.
The other question?
Second question is,
Yes.
What happens if he wins?
actually, which of the following bubbles do you expect to last earlier? The US $1 trillion educational loan bubble or the housing bubble in China?
Okay. So let me start with the housing bubble in China. This is very important. So I'm going to go back to this because you'll see. Remember, China, loans to the private sector are 19% of GDP. Look at this. There, you see? So the household sector, that includes mortgage loans. The household sector is not leveraged in general, and most people who have 2 or 3 homes are among the wealthier. So their loss of wealth will be among the wealthier in society. So that is occurring now. I'm afraid I don't remember the exact numbers, but it's over a year now that house prices have declined. And in some areas, but I don't remember which areas, something in the order of 15%. So it's happening. It's likely to continue to happen. It's not going to have a major macro impact on China. And it's politically acceptable because it's happening among the wealthier. Okay. And in the U.S. $1 trillion education loans, just as America is very good at defaulting on residential loans, those young people will just default on their not all of them, maybe 25%. So that's a loss of $250 billion. And banks like JPMorgan will take their share. So I think, again, it's sad, we regret it. Now, for the U.S. economy, you asked for the outlook and... Okay, yes. So, it's likely, okay, if President Obama were to lose, it's very likely the U.S. would be able to reach an agreement concerning its fiscal challenges much more easily. Much more easily. So, the famous slide 7, really is my best slide, that ratio can go up by eliminating exemptions. That's not easy to do, but you could actually have a tax reform in the United States that would be growth promoting. I mean, there are lots of people in the U.S. who study the U.S. tax system, so that could be a big positive. And it would be easier if Romney were president.
What about unemployment?
So unemployment now is, as you know, 8.1%. Right. And I think it's my prejudice. I was a supporter of President Obama. I was a big supporter. Now I'm not. But I do believe you would have a greater chance of tax reform with a Republican president and higher growth. Unemployment will only go down slowly in the United States because people don't understand the cost of health care. This new legislation is beyond comprehension, and because of a tax system that doesn't work very well. So that's not a satisfactory answer, but I think, from a strictly economic perspective, everyone makes fun of Mitt Romney. I mean, everyone does, right? But this is someone who's achieved a great deal in life. He's done a lot of good things. And he's not charismatic, but I think he would make a good president. But I don't think he's going to be elected. I think Obama will win. But if he were elected, I think that would be very positive for the dollar and very positive for global growth.
And just to add to that, the electoral prediction market is now given 58% probability of Obama winning. But the victory will be 51%.
Yes.
So it's a very close race, but the probability for Obama winning is actually high.
So my boss and I, we go down to Washington, again, every 6 weeks. We're there June 5th again. And we meet with, these electoral experts the whole time because it's such a big call. It's a huge call for our bank.
Okay,
Thank you
finish
very
on
much.
time. Thank you very much.